Thank you so much for the partnership. We really appreciate the relationship and the opportunity to be here today and talk to you about private credit and the Hamilton Lane Senior Credit Opportunities Fund. So great to see you all here today. I appreciate you taking your time to come spend some of it learning about us. Please let me know if you can't hear me okay. It sounds okay from where I'm standing, but give me signals. First, I do want to spend one quick minute on who Hamilton Lane is. Yes. Real quick, many of you probably haven't heard of Hamilton Lane. That's okay. We are really big in the private markets. If you look at the numbers up there, we've been around for 30 plus years. We started our business working on behalf of large institutions to help them invest in the private markets, private equity, private credit, private real estate, those various asset classes. We've done it for a long time. We've done it very well. We've done it on a global basis. So our clients represent many of the most sophisticated platforms and institutions globally, and they come for us for expertise in building private market portfolios for them and accessing the asset class. So we're really proud of the business that we built, the client base that we have, and the trust and the relationships that we have built with our partners over time. And I'm going to learn to use this the proper way. We've also been doing private credit for a really long time. So we manage about $72 billion of private credit assets. So in the private markets, that's a pretty big number. We have over 300 credit partners that we work with, and a very long and profitable track record of investing in the private credit space. So I won't make this too much of a commercial about the firm's track record, but it's obviously an important point when you think about who you're investing with in different asset classes. Our secret to our success is through 30 years of being in the private markets, we have great partnerships with all of the best managers globally. Those can be credit managers, those can be equity managers, those can be infrastructure managers. We serve as a partner for all of those managers in completing deals or completing transactions. So we'll talk more about that when it comes to the Credit Opportunities Fund, but that length of relationship, the depth of the relationships that we have, and that global footprint really create tremendous advantages for us as we can look across the entirety of the private markets to find the most interesting things to do. One of the big challenges with the private markets is that you can't go on your Bloomberg machine and find information on what's going on there. It's private. So having the depth of the resources in the databases is a huge advantage. Many of you have heard about the private credit market opportunity. People are excited about it. People are talking about it. We would say for very good reason overall. And I know you heard some of this from Michele on your recent presentation, so I won't spend too much time on what the market is or why the market exists. But the really big part about private credit is it's simply compared to public credit, which you can go buy pieces of securities. These are privately issued loans, usually with a single manager or a small number of managers, and they are senior claims on the business that you're lending to. So it's a very simple asset class, and you're at the top of the capital structure. So from a risk and return perspective, you are taking less risk, and you're getting the benefit of having very good collateral in these businesses and creating income and stability compared to equity returns. There is a reason people are talking about the private credit opportunity, and it's because banks are not doing enough lending for the landscape that they're serving. And so more and more lending has moved away from traditional banks and moved to private sources of capital. And that's simply because banks have gotten very large, they're highly regulated, they're often not the best place to hold loans. And so increasingly banks are looking at other ways to have relationships with their customers, and they're looking to offload that actual loan. And so the private credit market has been a really good place to step in to fill that demand for uses of capital. And it's a much more flexible lender than banks are, and it's a much more customized lender than banks are. So that private credit market has grown significantly in recent years, particularly coming out of the great financial crisis, and has tremendous tailwinds behind it in terms of future expected growth of the market overall. This might be the best chart in the deck on the asset class. This is not specific to our track record. What we're showing you here is how private credit performs compared to public credit. And if you look at the dark blue bars compared to the light blue dots, you'll see that private credit has beaten public credit in every one of the last 20 plus years. Pretty good case on the performance front. It has been a higher performing asset class overall. One of the other things that investors really like about private credit is the low variance in returns. So private credit is steady and stable, which is what we're showing you on the far left side of the page here. The variance between a good environment and a bad environment in private credit is fairly narrow. You're lending money, you're expecting to be paid back your money and your interest, and as long as you don't have bad loans in the portfolio, we'll talk more about that, your outcome dispersion is fairly narrow. So investors can count on the stability of that return coming back to them. So relative to other asset classes, that private credit has been very high performing with very low volatility or variability of returns overall. So you can count on that. This is also an interesting one because we always like to look at the downside of various asset classes. So what happens if things go really, really wrong? And so here we look at the worst 5-year performance over the last 35 years across a host of asset classes. And you can actually see that the worst you've done in private credit in any time frame is a 4% return over that period. Now certainly that's not what anyone expects or is hoping to achieve, but look at what other asset classes have done on a comparative basis. They've done much worse. So the stability is there. The worst case performance for the asset class has been very good on a relative basis, giving investors confidence that that private credit strategy will be able to deliver what they expect out of it, that stability, that income, that return. So I'm going to pivot for a minute to talk about what we call scope. Apologies for the lingo here, but it's our Senior Credit Opportunities Fund. And I'd like to highlight a couple features of the Scope Fund. Our fund is focused on senior secured private credit. That is the senior-most portion of the capital structure with full security in the underlying assets. That top of the capital stack feature, the most senior part of the capital structure. Our fund is an open-ended fund, which means investors can invest on a monthly basis. The fund takes in new assets and we purchase new loans or issue new loans against the portfolio, giving investors flexibility to invest when they want, which is part of the reason it works well on this platform. And our target returns are 8 to 10% net. Now, one of the real benefits of private credit is that it is a floating rate credit. So when we're issuing loans to companies, we're paid a base rate plus a spread. And so as interest rates move, we are not taking interest rate risk in our security. We're moving along with those base borrowing rates. And so investors aren't trying to time what they think is going to happen to interest rates like they do with bonds as they think about investing into the fund. Importantly, we make distributions out of the fund. We have to asterisk this as a targeted distribution. Our current distribution rate has been higher than 8%. I think it's about 8.5% today. But we pay out the income that the fund is generating to investors so that they can have that current yield on a quarterly basis out of the fund. And the benefit for investors is when you subscribe to the fund, you are buying into access to that full fund day one. So your money is fully deployed, invested in the ground, earning these returns and the distributions that we're talking about. The fund has now been around for several years, and so that track record is built up over time. So we're trying to make a comparison here just to compare open-ended or evergreen structures to traditional drawdown structures. And I don't know how much time any of you are spending in the drawdown space. I think part of the beauty of this fund structure, this open-ended fund structure, is that investors can invest monthly into the fund, and that they can also request redemptions to be redeemed out of the fund on a monthly basis. So it gives investors the flexibility to control when they get liquidity out of the asset class versus being locked up in a vehicle that has a very long life. I think that this overall makes accessing the asset class much easier for investors. Smaller investors are able to access the market the same kind of way that large institutions are. So it makes access easier for investors to be able to participate in terms of operating requirements, disclosures, access all of those points. So what is Scope? Well, this is actually what we own today. So here's a great snapshot of what the fund is. Today, we've issued 72 loans to underlying borrowers within the portfolio. The fund is almost $1 billion in assets. I don't see, there it is. It's up here on this slide as well. $900 million in assets that we've grown since we launched the fund about 2.5 years ago. It is 100% senior secured first lien, which is the highest quality credit within the credit space. And it's 100% floating rate security. So assuming interest rates, I think everyone a year ago expected interest rates would have fallen by a lot more, particularly in the US. By this point, they haven't. They've remained higher. Investors in this fund have benefited from that because those short-term rates have stayed higher. They're able to fully participate in those higher interest rates. We are mostly focused on North America. That is the largest, deepest private credit market, 93% of the portfolio today. That will always be the vast majority of the portfolio. It's a very attractive place for private credit investment as the largest market. And importantly, we want to be really diversified. One of the things that private credit investors need to think about is making sure that you are diversified in terms of the underlying companies that you're lending to. It's important not to have credit losses in the portfolio, and concentrated portfolios are more susceptible to that. So the fact that we have 72 loans across different industries, alongside different credit managers and equity managers, we think is a really important point. The other thing is, I'd like to point out a couple of the statistics on the types of businesses that we lend to. So people often hear private credit and they wonder why a borrower would borrow at higher rates than a bank might offer them. And the reality is that the banks often are not very flexible in terms of what they're willing to do. So think about it in terms of if you're a customer, sometimes you're willing to pay for customization for something the way that you want it. And so a bank, if they're going to issue a loan, might have very strict criteria around the types of things that they're willing to do and the flexibility they have and the process you have to go through a bank in order to get a loan. The private credit market can be a lot more responsive, and borrowers are willing to pay for that responsiveness and flexibility. So the businesses we're lending to are actually fairly well-sized businesses, $181 million of EBITDA on average. So these are real businesses. Think about them as might be $1 billion company that's a regional market leader with real cash flow and real assets and a real customer base. We're lending to them at about 5.2 times debt to EBITDA. That's an important metric. That's how exposed the credit is within the capital structure. But the next number is probably more important, that loan to value. So we are loaning 40% of the value of the companies. And in all of these cases of the companies that we're investing in, there's a equity sponsor that sits beneath us in the capital structure that is injecting cash that is worth the other 60% of loan to value. So one of the ways that we've experienced a 0% loss rate or a 0% default rate in our senior credit portfolio is because we're lending to businesses that have very capable owners behind them with very deep pockets and a lot of their own money invested in these assets. So if something starts to go wrong, you look to these owners to be able to step in to provide cash for the business to be able to support the loan. And while that occasionally does happen in credit, it's important to have that kind of depth behind the assets to be able to support it. The current coupon on the portfolio is 10%, so we do make 10% off of the current loans in the portfolio. That's a function of the base borrowing rate, which today is just over 4%, and then our credit spread, which is a little bit over 500 basis points today. So that is what the borrowers are paying us. So sometimes the way to make this the most tangible is to give you a case study or an example of a business. And I'm going to use the Ultimus example here on the far side of the page. These are all companies within the portfolio, loans that we have made. And I think any of them could be illustrative of the types of ways that we make loans and the way that the company are looking to do financing. But Ultimus happens to be an interesting case. This is a private equity owned business. It's owned by a firm called GTCR. It's a very good private equity firm based in the US. They have a very long track record. They've actually owned this business since 2019. And funny enough, we were invested in a company previously that was sold to Ultimus. So it was a company called LeverPoint. It got acquired by Ultimus. Our loan was refinanced out, our equity was refinanced out of that deal when it was sold to Ultimus, but we knew the base underlying business going back many years. The company itself was coming to the private markets for a new loan because it wanted to continue to do acquisitions. They had done a number of acquisitions over time, as illustrated by my description. They wanted to be able to keep doing acquisitions. And a traditional bank loan is not great if you want to be able to keep making changes to your loan document or a partner that really understands your business. And so they went to their lender, Onyx, who had lent to the business previously, and said, on what terms would you make us a new loan? And we'd like the flexibility to make acquisitions. And then Onyx, with us as a credit partner, were able to say, here are the terms on which we're willing to lend you money. And so our coupon in exchange for that loan was the base rate, SOFR, plus 550 basis points. Again, SOFR is just over 4 today. About a 9.5% current yield on the loan. We loaned the business about 5.5 times debt to their EBITDA levels. And we had a 60% cash cushion from the equity owner beneath us in terms of the security. The company, again, was willing to go to private credit to pay a little bit more for that customization. And the business is a wonderful business. It's the leading player in the fund administration business. That's a boring business. It has 99% customer retention. It has 30% EBITDA margins. It has very high free cash flow. It is steady. It is stable. And a really good example of the types of places where we have relationships with the equity funds that own the asset, as well as with the credit lender that is leading the terms of the loan. And so if I were to go through all 70 plus positions in the portfolio, you'd hear very similar stories of places where we have relationships with the equity owners. We have views on whether they're the right owners for those assets. Our credit team is spending weeks or months on diligence to pick the specific loans that we want to underwrite into the portfolio. And that generated a really nice track record for us of lending into the senior credit space. So say that really is a good illustration or a quick primer on our Senior Credit Opportunities Fund. I think that had really wrapped it in terms of just making the key points again. I know we're going to get into some specific questions around the fund or the strategy or the market as part of this. But I think the overall key messages are that Hamilton Lane has a long track record in this market. The private credit market is an attractive place for investors. And the fund structure, senior credit, 8 to 10% returns, dividends out based on that stability of income, and ease of use for an investor to be able to invest into the fund or to redeem out of the fund are really the key points that I would make in terms of the scope opportunity. So thank you for that.
So thank you so much, Brian. And when I introduced you, I just realized I didn't give you your title.
That's it.
So Brian, no, but I think it's important because it explains kind of where your perspectives come from. So Brian has been, if I remember correctly from this morning, you've been for 16 years.
That is correct.
That's a long time. And actually, I'm always positively impressed by everybody I meet at Hamilton Lane. I've been there for at least 15 years, which is always a good sign.
It's a good sign.
And a fund manager. And Brian heads the Evergreen portfolio team. So Evergreen portfolios, Brian was talking about the fact that this is a semi-liquid product, so it's not a closed-end fund. Maybe you want to explain what Evergreen is?
Sure, absolutely. Yeah, so Evergreen in our jargon, and I apologize, that's a very industry-specific term, means that open-ended funds that investors can subscribe to and the fund can continue to grow and can allow investors to redeem out of. So it's more like a living fund. Traditionally in the private markets, funds were closed-end where you raised money for a period of time, you invested that money, and then the money got sent back to investors, which is obviously a more complicated fund structure. So at Hamilton Lane today, we manage over $8 billion of evergreen-oriented funds. And what me and my team do is think about the differences of managing a portfolio that's in this structure compared to the traditional closed-end fund. So we have investment teams that are experts in the credit or the infrastructure, the underlying asset classes. And then my team is very focused on the portfolio construction of taking in investor inflows, building the right portfolio to generate the risk, return, and liquidity that investors expect out of that portfolio.
Thank you. So you've said a lot of things, and hopefully you now feel you know a bit more both about private credit as an asset class as well as specifically the fund. But maybe there is one thing that I'm always interested in learning a bit more, and you briefly spoke about it, but I'd like to go a bit deeper, which is how you source opportunity and what is what I call the Hamilton Lane advantage. It's one of the reasons why we like partnering with you guys is that I think you're a very different animal from some of the other large private equity and private credit managers. So maybe let's talk about sourcing for a second and what makes Hamilton Lane different in the sourcing.
Sure. Absolutely. So for us as a firm, I mentioned earlier, we've been around for 30 years. We have long-standing relationships with both credit managers that are originating these loans and looking for a partner to come in and take a piece of the loan with them, and with the equity managers that own these companies. And so our sourcing actually comes from both of those places, and let me give you a couple examples. Why would a credit manager want to bring in another credit investor to their fund? Well, if you're a credit manager that's going out and finding these companies and originating these loans, which we are not doing, we're not finding the companies originating the loans, you want to control that loan. You don't want to bring in another credit manager that might compete with you to be able to take over that loan. So instead, you call one of your trusted partners and you say, Hamilton Lane, would you like to participate in this loan that we're going to issue to this company? So we have the benefit of several hundred managers globally that are going out and finding companies and looking for credit partners to partner with them to help them with that loan. So they control the market, we provide capital, we choose where we invest with them. So we're picking a specific deal each time. And so we have several hundred opportunities every year to invest in individual loans, and we're only investing in a very small percentage of those opportunities that we see. Conversely, the equity managers in other parts of our business, not in this part of our business, are important partners for us. In other parts of our firm, we invest in private equity funds as an investor. And so to those private equity owners, they're going out and they're finding their lender to set the terms and price their loan, but they're very happy to bring in a friendly partner of theirs to take a piece of that loan. And so we're able to play either through the equity owner or the credit owner in investing. And one of the real benefits that we have is because we have a big database on the asset class, and because many of these companies, like the one I described, Ultimus, have been owned by private equity or have had loans to private credit before, something like 80% of the loans that we see are coming from companies that we have prior historical information on. So can you think about that dynamic of a new loan comes in and we happen to have seen the investment several years ago or seen the reporting on the company to know how it's done in different market environments. So we think that's a tremendous advantage of letting us partner with different specialist managers and getting access to a broad set of the credit market, which provides investors with that diversification by geography, style of investing, all of those things that are really important to an investor.
Perfect. Let me make it, thank you for this. I always find it fascinating, like the differentiation of Hamilton Lane from a sourcing perspective. Now, maybe let's make a bit of a step back. Private credit is a label that you increasingly read about in the newspapers or Bloomberg or whatever. And the reality is that it's a very large word. And what we're talking about is a sliver of private credit, right? And I tried to explain it, if you participated in the webinar a couple of weeks ago, I tried to explain a little bit the differences and why I didn't talk about the fund specifically, but I did speak a little bit about the advantage of investing in kind of sponsor-backed transactions and kind of focusing on first lien secured, kind of what you guys do. But maybe making a step back, can you talk a little bit about private credit more broadly so that we can then differentiate what we are doing here versus some of the things you might read on the papers?
You're right. So terms like private credit can be really broad. It would be any kind of loan that's not publicly available. What we're talking about here specifically are loans to profitable companies, private equity owned companies. Sponsor-backed was the word you used, so that's a good term. They have an equity sponsor that is part of the capital structure that owns the business, which speaks to those deep pockets that I talked about if things don't go well. And we're making traditional loans to traditional businesses that are generating cash flow that have assets that are very secure. So other parts of private credit could be more like accounts receivable financing or investing in hard assets and lending against those. This is really sponsor-backed middle market private equity loans, which is probably the largest part of the private credit market, after real estate and some things like that. So this is not real estate either, I should make that point, or infrastructure. these are loans to real corporate borrowers with credit and revenues and assets.
Perfect. And when you had a slide on returns earlier where you were saying target return 8 to 10% inclusive of leverage. I have two questions here. One is, broadly speaking, how to use leverage, and then maybe tying it to the interest rate environment, because right now you're saying coupon is around 10%, which 4 plus on from the base rate plus 500 basis points in spread. Let's assume that at a certain point those interest rates will go down. Your target return remains 8 to 10% or not, and what is the role of leverage?
Sure, absolutely. So the 8 to 10% return target is across a long period of history in terms of interest rates. So we do expect, while the underlying loan rates are floating, as I described earlier, there are some protections on loans that protect the rates from falling too low. So sometimes there are floors on the base borrowing rate at which the loans can't fall beneath, or spread or other things. The other thing is we do use a modest amount of leverage on the fund. When I say modest today, it's at less than 10% of the total fund size. Over time, that could be 30%, so still fairly modest. But particularly in an environment where rates are lower, our borrowing cost of that leverage also falls. And so we're able to earn some spread on that borrowing. So we do expect the 8 to 10% net return works across a very broad spectrum of interest rates in terms of the underlying portfolio. And as I mentioned earlier, our objective is to distribute that income out to investors, which is what we've done today.
Perfect. So we kind of talked about risk from a few different angles, right? We talked about private credit as a broad asset class and why private equity-backed transactions tend to provide an interesting risk-return profile. We talked about where you sit on the cap table. So if you're doing secured transaction, if you're focused on first lien versus mezzanine, you actually obviously taking a significant less risk. We talk about 0% default rate. Now, I guess the other way, and you talk about leverage being a measure and a non-significant, focus on having a certain level of risk that is not excessive. I guess the other way to think about risk is talking about diversification. I saw that you have now 72 deals in the fund, which means on average, 1.5%. Maybe the biggest one, if I remember correctly, is like 3.something%.
Yes,
how do you think about diversification? And as the fund grows, I know it's obviously clearly growing quite quickly. What is the target number of deals you might have on the fund?
Sure, absolutely. So with these open-ended funds, you expect the fund to grow over time, and so you're always thinking about that diversification piece at a point in time based on where you expect the fund to be. Because we're accepting new inflows, we expect the number of investment positions will continue to grow. Some of the earlier positions are quite small today, given the fund was much smaller when we started making them. But we do think about diversification in the way that you just described. So we generally tend to think about having 2% position sizes for new investments. Some cases, the assets are such that we feel better about being slightly larger, or we have expectations on some modest fund growth, things like that. But in general, we expect that the portfolio will be over 100 names. But if you're able to look at roughly 2% positions at a steady state fund size, you're thinking about a big percentage of the fund being kind of in that 1 to 2% range. So having 100 plus positions, but the top 50 being roughly 50% of the portfolio overall. So nice diversification, and the loss rate that you referred to, or the default rate you referred to, is a really important thing, right? So our history in this strategy is a 0% default rate, which is great. I hope it stays that way forever. But also one of the things that's important is what happens if there is a default, and how does that work in recoveries and things. So that is where being the senior most portion of the capital structure is really, really critical.
Yeah, and the way I think about it myself as an investor, as I mentioned earlier, actually, I'm a significant for me investor in the fund, is that you have a series of layers that protect yourself. So, first of all, you have 0 default, but let's say there is a default, and let's say that it happens in your biggest position, which is obviously worst case, and it's 3% or something like that. Reality is that on a default situation, do you have some statistics on default situation for LBO transactions? What is usually the recovery rate?
Sure. So it varies very much by security. I'm going to get the specific number wrong. For second lien term loans, which are more junior or mezzanine term loans, that number would be lower. It might be like 40% or 50% recovery rates. Depends on the economic environment. For senior most loans, it's a much higher number. I'm not going to know the exact number offhand, but it is, I believe, well above 75% recovery rate. So if you were to have a default, when you're senior, you're recovering a lot of your basis still as well. And that's across the industry, not specific to our.
Perfect. That's what I was going. So the way I think about it is that, okay, worst case scenario, there is a default, and it's a large position, 2 to 3%. And let's say you recover 50%, which is much lower than what you think you're going to recover 75, 8. Let's say you recover 50%, so we're talking about 1.5% loss. You're targeting 8 to 10% a year, so in practice, I'm leaving on the table 2 months of return. Is that a good way to think about it?
That is a good way to think about it. That's right.
So, and I think this is important because it actually makes you kind of quantify what you have at risk at any point in time. In a bad case scenario, you're saying, no, this year instead of making 9, I'm going to make 7.5, which I think I personally can live with, especially given that usually historically it's been 0%.
Correct. Default rate times recovery is the right way to think about it, for sure.
Perfect.
And how you recover, by the way. So again, that's really important. That the way to maximize recovery is by having taking proactive steps with the equity owners, by being ahead of the curve and finding ways to maximize value when that happens. So don't assume that all recoveries occur equally. Having the right equity owners with deep pockets really helps your recovery rate as well.
Makes sense. How often do you expect to actually take possession of the equity?
Hopefully never.
Makes sense.
There are lenders that specialize in that strategy, though. That is a different strategy. There are lenders that look to do that. They look to make higher returns. It's a riskier portion of the market. That is not what we're doing here. Think of this as boring, steady, stable part of the credit market.
Makes sense. So when you had a slide with the 3 examples, and you had both a credit partner and equity partner, and you mentioned how that works, right? There is a equity, like a private equity, that is making a transaction and is looking to kind of put 60% on average of the price value in equities, looking for somebody to sponsor the remaining 40% in credit. There is you guys plus some other credit partners. One of the two, either the equity partner or the credit partner might get in touch with you. Usually, how big is your position as a percentage of the total credit?
Let me think about that for 1 second. The average loan in the portfolio is about $400 million. And if you think about our position sizes there on a relative basis of $30 million on average historically, we're under 10% of the loan size.
Which also means that as the fund grows, you will be able to actually do the same type of transaction you're doing today, but simply taking a bigger slice of the pie.
Correct. That is what we have done to date, and that is the expectation. That's one of the beauties of the part of the market that we're serving, is that the fund can grow without changing the opportunity set, and our credit partners would often be very happy for us to take a larger portion of those loans. That's right.
Makes sense. So the 3 examples here are very different companies. You have an education services company, you have a fund administration company, and an agricultural chemicals.
Yes.
Do you have any industry preferences, biases, or things you don't do, things you want to do more?
Sure. So I would say yes, some preferences, biases, things we won't do. So we're not a real estate lender, we're not an infrastructure lender, and these are profitable businesses with earnings. We are nicely diversified across credits, across segments let me just show it here a little bit, but industrials, financials, healthcare, software, things like this. I would say at any point in time we do have our biases, so consumer is kind of a less loved point at this point in the cycle. In many businesses, there's a lot of disruption there. So we may have things that we like more or less, but I do think broadly we're looking across the entirety of those kind of cash flow positive, traditional businesses and figuring out what we think works for the current environment. So every time we're issuing a loan, we're looking at the industry conditions, the company's market position, the equity owner, and their plan for the asset. That's a really important part of the strategy, is what is the equity owner going to do with this business? And then we want to be diversified across those things.
One last question on kind of the overall sector, and then maybe I want to go into a few technicalities. And if you have any questions, I'm going to open the floor. So start to think about it if you have any questions. So the first one is on broadly on the market. as we hinted at earlier, private credit has become more talked about, more distributed over the last few years than it was some years ago. And so one of the narratives you can hear is, look, as more people want to invest in private credit, there's going to be a compression in return because there's going to be more money chasing the same deals. Is that a fair expectation? So, fast forward 5 years, you're not going to make 8-10%, you're going to make 6%. Is that fair?
Sure. So I would say we've heard that narrative for 25 plus years about all of the private markets, private equity, venture capital, private credit, infrastructure. It's never been proven true in the past. What I would say is the broad capital markets are growing at pretty high rates themselves, and banks are just doing less. How many new JP Morgans are there out there? Not that many. And so the reality is we would say no, that we don't think that the private credit market has too much going on. What does ebb and flow a bit more, which does impact spread on the larger end of the market, are the public credit funds tend to be a little bit more on and off in terms of their market environment. So sometimes you see some of the public credit vehicles in the broadly syndicated market become a little more active or a little bit less active. That does impact spreads from time to time, but in general, there's a massive need for private credit, and these managers are stepping in to fill a void that banks are not filling today.
Thank you. So I was just looking at my notes, and there were 3 topics I want to talk about on the technical side, but actually we touched on 2 of them already. One was leverage, we talked about it. One was risk, and we kind of tried to peel the onion a little bit of how you think about risk, how you think about default rates, recovery, and kind of where you are in the balance sheet. So we talked about that. So let me talk about liquidity. So as we mentioned a few times, this particular fund is semi-liquid, Evergreen. What does it mean? And how does it work?
Yeah, absolutely. So the way the fund works is that investors are able to subscribe to the fund monthly. So we take in new inflows, we take that cash in the portfolio, we invest it into new loans, and they're also able to redeem monthly out of the fund. But we do limit those redemptions to 5% per quarter at the fund level. So at the fund, we make sure that we don't have more than 5% going out per quarter. Any individual investor isn't specifically limited to that amount. It looks across the entirety of the fund. So the way that would work is that if only 4% of investors want all of their money out, they could do that. But if everyone wanted all of their money, it would be pro rata across that amount. And the reason to do that is to protect the portfolio and to manage the fund the way that we need to generate the returns that we're looking for in the private market. So my team's responsibility is to make sure that no matter what, we have 5% available to go out to investors every quarter. And we have built a portfolio based on historical data and based on the types of things that we're investing in that enables us to be able to do that effectively. Now, to date, every investor that's ever wanted liquidity has had liquidity in the full amount that they've asked for out of the fund. But we need to make sure that we're setting the protections and the expectations the right way for investors as well in these structures. That's the key to these semi-liquid structures. They work very well, but that needs to be the base expectation in terms of how liquid is the fund if many investors want to get out at the same time.
Thank you. So, last question for me before I open the floor. This morning, there was an institutional Hamilton Lane investor, and I went there as a statutory representative, and Brian was a speaker, and you were talking about risks you see in the private market, and you said that in 2020, 2021, you said venture capital seems to be a little bit overexposed. And you said that today, you actually see as one of the risks the kind of a distribution of private markets across maybe channels that are new and therefore create further risk.
Yes.
In the room you might have quite a few people that are probably for the first time approaching private credit, private market in general. What are the things that people should think about as they think about adding private market exposure, private credit exposure to their portfolios, and why do you think there are risks there?
Sure, absolutely exists. So the point I was making earlier is that there's investors that are newer to the asset class should understand the asset class and the fund structures and strategies and what they're intended to do. So it's been a really good asset class. I showed you a lot of reasons why. But the other thing that we always talk about is the importance of positioning this as a long-term strategy. So for the investor that's looking to be invested in something for a month, or 2 months, or 3 months, while this strategy is the most consistent of all of the strategies in these structures, that's really not what these structures are intended for, right? They're intended for an easier way for investors to get access to a less liquid asset class in a format that's really easy. So the biggest thing is think about your long-term investment objectives, think about what you're looking for out of this strategy, and try not to make decisions week to week or month to month. I know that happens in the public markets all the time, but really our asset class has outperformed because we can take a longer-term view, and that is an important way for investors to think about it as well. So I think the specific risk I was talking about was that as there are more funds in these types of structures, it's important that the end investors recognize that if something happens in the global economy, that's not the time where everyone is going to be able to get out and be liquid out of these funds. That's not what they're set up to be able to do for investors.
Fantastic. Any questions from the audience?
Yeah, thanks for the information. So I'm basically invested in this, but I wanted to know, why don't you do monthly distribution instead of waiting quarterly distribution? Because even in quarter, it takes really 4 months to get the more clear.
Yeah, honestly, it's something that we've talked about, thought about. There's an administrative element that has made it easier to do quarterly, but I think this market continues to evolve, and we try to be thoughtful in the way that the market is evolving. In many cases, by the way, our underlying loans do pay us on a quarterly basis, so there are some things that go with that we should think about as well as part of that. But I think it's something that we're thinking about as the market evolves.
I know I already asked you earlier one-on-one, but I think it's an interesting question for everybody. What's your ratio of payment in kind? Because I've learned today that this is a big question or important question to ask every private debt fund.
Sure, yeah. So the specific question, if I can expand upon it, is that often in loans to companies, there's a provision where if they choose to, or they're unable to pay their cash interest, they can choose to PIK interest or interest in kind. And so what happens in those situations is the loan balance grows, that the obligation to the lender grows because they're saving cash and not sending it out to the lender. So often, and currently the way it's being talked about is a warning sign that those companies may not be able to support their debt, and therefore they are starting to become behind on their payments, which is true. There have been some articles in the press about it. I think the overall article we talked about might have shown that in some of the broadly syndicated funds, it may be up to 5 or 7% of some of their portfolios are paying PIK in kind interest. Ours is well below that. I'm not going to remember the exact number. I believe it's one company out of the 75 plus positions that have paid any kind of interest in PIK. So the point is, we've looked at this very closely. We do not believe it is an indicator of anything in the portfolio or that we're concerned. But that is one of the topics that starts showing up more broadly in the markets. I would say our overall view is that the private credit market has remained pretty healthy. I think the specific funds that are having challenges were making loans several years ago before the pandemic, probably most likely, and also we're doing much more syndicated broad loans than being very specific about the assets they're backing, and so probably picking up a little bit more of that market risk to some challenged lenders. But it's an excellent question to ask and one that should be on investors' minds. That's why we talked about that default rate earlier. What do you think about when you look at a credit fund? How long is the manager's track record? What kinds of things are they doing? How consistent is it? And what have loss rates and recoveries look like in those scenarios?
Yeah, I've got a question on interest rate sensitivity and the leverage as well. On the 72 loans that you have, do you do any stress testing or sensitivity analysis, and what's the range that we're looking at?
Sure. So we do a ton of sensitivity. So anytime we're underwriting a loan, we have access to company models and a credit lender case and a downside case. So we do all those kind of stress tests against the initial loan. I would say interest rate stress tests is something that is, I guess, the band of outcomes at which we underwrite. I would say we do fairly wide. So what happens if interest rates fall significantly or they rise fairly significantly? The reality is that cash coverage and interest rate coverage ratios are very healthy for companies today. We just went through an environment where interest rates moved up quite a bit the last several years, and you saw very, very low private credit defaults. These companies are generally well capitalized. They have great margins, like I just talked about, strong free cash flow. And while they don't like paying higher base borrowing rates, at the same time they've had plenty of availability to be able to do that.
You said earlier that your customers prefer to get private credit arrangements with you guys instead of going with banks because of the restrictions of the inflexibility of banks, right? That makes me think that you are less regulated than banks. So what is the level of regulation you have, and what's it for an investor in the funds? What's the risk, the additional risk that we have?
Sure. So I would think about that regulation in two very different ways. Banks, first of all, are levered generally about 10 to 1. So they're highly levered. Private credit funds are very lightly levered. So they're actually probably a better owner for assets than banks are. Private credit funds are not regulated like banks in terms of capital ratios. However, as investment firms, we are highly regulated. So we're overseen by the SEC in the US, we're overseen by regulators in every market that we operate in. So think about those regulations applying more to us as an investment manager with investor protections than applying to capital ratios the way that the banks have regulations, if I'm describing that correctly. Hopefully I answered that the right way for your
Yeah,
audience.
and I want to add something, because this is a question that in other contexts we receive a lot, because we are a fund manager as well from a regulatory perspective. So actually, in a way, even if we do different things, we're similar. And sometimes the question we receive is, why don't you have deposit insurance while the banks do? And there is a big difference between when you give money to a bank, the bank receives the check, the deposit, turns around and then gives a mortgage to somebody else and gives a loan to somebody, like it splits in different places. And the maturity there is a mismatch in maturity, meaning that you can actually get the cash back any day, like you can actually go to the ATM and put the cash out, while the mortgage might be a 20 years mortgage, right? And so that's why you're taking balance sheet risk for the bank. That's why once in a while you have banks defaulting, because you actually are taking, and then, as a depositor, you actually have a risk, which is where the insurance comes in, and which is where the super tough regulation of capital ratios comes in order to avoid that kind of a so-called bank run. In a fund management structure, that doesn't happen, because you have a custodian structure where that's separated from the balance sheet of the fund manager of Stashaway or Hamilton Lane, and therefore, the maturity of the money coming in is matched to the maturity of the money coming out. In this case, obviously, you do have this 5% gated liquidity, but as Brian mentioned, they always make sure that you have 5%. And if you make the math, if I remember correctly, I was having a conversation with colleague of yours. If I remember correctly, the average duration is 5 years, but actually gets repaid in 3 years.
Yes.
So there is 33% of loan are repaid yearly, plus you get 10% coupon, so 43% of the fund is actually generating cash flow on a yearly basis. So obviously you have way more than 5% a quarter to give out. So that's the big. So it's very. So the way a bank is regulated is different, because the bank is much riskier from a structural perspective than a fund.
And backed up by the governments often, right? Which private credit is not, but we have the investor capital ahead of time. Every time the topic of regulating private credit has come up in the US and regulators have looked at it extensively, they come to the determination that it is not a risky element of the market overall. Investors are making choices about what they invest in, to invest in our fund, but that unlike a bank, there's not a systemic risk that comes from the institution in a way that a bank has systemic risk coming from it.
Okay. Hi. How sustainable are these, because the coupons that these companies are paying is pretty high, it's 8 to 10%. Yeah, but yet most private credit fund managers that I speak to talk about the low default rates, the high recovery rates, with the kind of costs and interest that they're paying, right? Surely that there will be some stress in the market higher. But what makes this? When will this show up? Such high coupons that
Yeah, so the borrowers are paying a high base rate today because interest rates are higher than they were a few years ago, right? The borrow rate, and then the spread over that, we're getting 500 basis points of spread over the base rate. That number does move around in different market conditions. So a year ago, we would have said spreads were particularly high because many of the banks moved out, and that spread might have been 600 basis points. private credit historically has had a fairly narrow range of 400 to 600 basis points of spread over the base rate. So that is not, while companies are paying a higher total cost today, the spread really hasn't changed that much. And that's the premium they're willing to pay for the flexibility. I know people sit here and say, what companies would be willing to pay 10% for borrowing? But from their bank, they would be paying 8% today. And their equity owners that are putting equity into these companies are expecting to earn 20% on their capital. So they're happy to use 10% cost of capital as a way to enhance their equity returns based on their underwriting expectations. In terms of where it stops, I mean, you can look back, these are absolute numbers, but the way that credit investors get hurt are when there are big default cycles. So we did show a period of the worst, well, you see lower returns in the worst periods, but you do see a period where private credit, through the financial crisis, so this would be the 5 years coming out of the financial crisis, so it would have sustained losses in the crisis and recovered some of that. That is what happens in a bad economic cycle. I would say it's less a factor of higher interest rates and borrowing, and more a factor of if you have credit losses show up in the portfolio and you have low recoveries because the environment's hard to recover in, that is when you see lower performance overall. But the asset class has been pretty stable.
And these private credit, what it does includes mezzanine or includes?
That would include mezzanine, which is a riskier segment of the market.
So actually, I'm assuming that if you actually did this chart only for first lien secure, it would be even less valuable than this.
Correct, yes. Yes, so mezzanine would be more junior debt, which has higher returns, historically 12 to 14% intended returns, but also higher default rates and lower recoveries when things go wrong.
I have two questions. The first question is, now, you mentioned that there is no default rate in the portfolio, scope of the portfolio. But is there any of the borrowers, having fallen, in repayment in areas? I mean, at what point in time would that trigger a default? How would you classify default? That's the first question. The second question is, how would you compare investing in ETF versus private credit? Because, in ETF, you probably get anything 10, 12, right? Last year, the downside is there, but the risk of loss, the loss, may be very marginal.
Sure.
The fact that they've been public listed companies, regulated, so to speak, And I think the third question, I also have another question. So, what you mentioned is the origination is by credit manager. In other words, you actually don't originate. You're actually participating in a syndicated loan arranged by the credit manager. Am I correct?
That's correct.
So
yeah,
you
I would say
basically
syndicated.
don't have a relationship with
Yeah.
the borrower.
Uh,
It is the credit manager who has the relationship. And that makes a lot of difference in risk assessment. Because not having a relationship, you're not privy to a lot of information.
Sure. Let me start with that one, the relationship. So when we think about making a loan, I mentioned we have a credit manager. I would say who's not syndicating the loan, who's leading the loan themselves. It's a firm that we've probably invested with in our history. We're probably an investor in their fund somewhere else in our business, and we know their skill set and their track record really well. So a credit manager that we trust, that we value, that we have a partnership with is coming to us and saying, we're going to own 80% of this loan. Would you like to own 10%? And we're going to call one other credit partner that might also earn 10%. You're right in that we don't have the direct relationship with the borrower. We maintain the ability to enforce our credit protections.
So in terms of recovery, the credit manager is actually fundamental to it. And whatever recoveries you do is actually through the credit manager. You have no right, because you are just a participant, maybe 20%.
Sure, yeah. We do, we legally have a right, because we are...
you can
Correct.
instruct the credit manager once a default is triggered. But then he has a majority share in that flow.
Correct,
So
yes.
he has the absolute say, the
Correct.
final say.
Correct. And so what we're doing when we're looking at that loan is evaluating the credit manager. Do we think they're a good manager? Do they have a good track record? Do we think we'll be aligned with them if they have to make choices? But you're right, they will make their own choices that are in their interest to protect their loan.
Right.
And part of what we're doing in all of these loans is making sure that we think we have a really good credit partner if things go the wrong way. So is that manager capable of rescuing the company if they get into a troubled situation, or enforcing their protections in a way that benefits us? So you're correct that we're relying on their skill set. We have our own protections and rights, but we're relying on their skill set. And that's part of our value add, by the way, is knowing which managers are good in that segment.
See, my
Can I-
uneasiness there.
Can I ask
Maybe
you
we
not
can
to, yeah, because otherwise, because there's going to be other questions, so let's maybe go through the 3 questions that you asked,
Yeah,
and then
okay.
otherwise it becomes a one-on-one conversation.
Yes, it sounds like you have lots of experience in private credit. So the other question was about default. So you're correct that companies can do things before they default. So default reflects their falling behind on a legal obligation that they have. So in advance of a default, what a company will generally do is go to the private lenders and say, I'm having trouble making my interest payments. Can I pick interest, or can I do something different with my loan? So we would then individually make a decision around what we're willing to do. The PIK interest is actually an excellent question to ask, because that is a leading indicator of a company that is falling behind on their payments but isn't yet in default. And so again, that is a leading indicator that companies
At
might
what
be
point
having.
in time that triggers a default? At what point in time when the installment is already to arrears?
Yeah, yes, when the company has breached, we should probably follow up on this one too, but when the company has breached an obligation in their credit document, that's a default.
I mean, in a banking context, 90 days, a loan can be classified.
Well, but every credit document is customized. So the company has obligations to the lenders, and they can be very specific about what causes default. So not providing financial information to a borrower is a default. There can be lots of mechanisms for what drives a default. They're very technical and legal in nature. Missing a payment would be one, not providing it. All those things would be events that cause a default. The third question was about.
Maybe I'll take the one. The one is ETFs versus private
ETF.
credit. So yeah. So first of all, it depends what ETF you're thinking about. You know, you can invest in an ETF that invests in a money market fund, or in 3 months US Treasuries, or you can invest in an ETF that invests in artificial intelligence company, and anything in between. So the ETF is not an asset class; it's just a vehicle to get exposure to an asset class. So it depends on what you compare. Now, if it looks like what you had in mind were returns probably equity-like, so you said 10-12%. So equity ETFs compare, so it's a different asset class. You're investing in equities. Yeah, you're investing in equities, while this is credit. You are investing obviously in the public market. This is, for instance, the MSCI World Index. You're going to have, there is an ETF on MSCI World Index. This on average will give you 8% per annum over a long period of time. There's going to be some years, like last year, where you get 20%, and some years where you, like in 2022, where you get minus 18%. And so it's going to be much more valuable. There are now some private credit ETFs, what they call it private credit ETFs, but they're actually very, very, very different. So they invest in what is called BDC, right?
Yes.
So yeah, they invest in something called BDCs, and they try to mimic a little bit the returns of private credit. But this is an asset class where you want to be active, meaning you want to select. Stashaway. I started a company because I believe that for the great majority of asset classes, you're better off investing passively with low-cost ETFs. That's something I believe in profoundly. That's the philosophy behind Stashaway. There are, though, a few exceptions. Private credit is one of them. You want to actually have somebody picking companies one by one, which is why you're not going to find a private credit ETF even in our flex portfolio. There was a question there for like a long time. I just want to make sure that we're not just too left-leaning, we are also some right.
So question is like the valuation of the fund that you do month over month, like how does that work? Because what I feel is there's no mark to market kind of thing over here, right? So if I have to, let's say, put in money, at what kind of fund value sort of I enter it, and when I get out month to month, how it changes, and in between if there is a default, how do you sort of update the fund value?
Sure, absolutely, great question. So actually every asset in the fund is valued every single month, which is how we report values to investors. These private credit loans tend to be pretty stable in terms of their valuations, but there are independent third parties that are part of that process that are looking at each individual loan in terms of the company's performance and also market spreads to see if there have been huge changes in credit spreads that would be reflected in the underlying loan values. Again, so it does happen, someone's looking at it, but they tend to be fairly stable unless something very company specific has gone on where they'd be marked down, or something very market specific has changed in a pretty meaningful way.
Just follow up on that. Like if there is no default percentage, if the company deteriorates, does that impact the valuation of the company?
Sorry, I missed if the company does.
If the health of the company deteriorates, but it hasn't reached
Yes.
default level, does that impact the value of the company?
Correct, it would. So if the company deteriorates, the market would expect that company to pay a higher interest rate on the current loan, which would cause you to mark down the current value of the existing loan, because you'd be looking at comparable credits to see what they're paying, and you would see that comparable credits would be paying a higher rate than you'd be paying at that point in time.
Let's have one more question, and then I think Brian has been very generous with his time. Yes.
Hi, an easy one for you. In terms of private credit space, how big is Hamilton Lane relatively to competition in terms of asset under management? Top 3, top 10, top like middle of the pack?
Wow, so that's an interesting. So I showed a number earlier on the credit business with 72 billion. We would not be in the top 10 credit managers when you think about. There's lots of insurance and life and companies like that have massive balance sheets. In terms of investors like ourselves that are asset managers and multi-managers, I would expect we would probably be in that top 10 kind of category. So the names we all know in the public world, the Apollos of the world, are multiples and multiples and multiples of our size. But for the types of firms that do what we do, we are a fairly sizable player with a long track record in this space.
Okay, and related to that, the 8 to 10%, how do you compare it versus competition?
Sure, yeah, absolutely. So we look at those returns last year in the overall fund. We would say for what we do, our fund numbers look really good. There are funds that use more leverage out there, which will have a higher return in good environments and probably a tougher return last year. So more volatility. What we have gone for with the senior credit fund is that consistency of that 8 to 10% with very low leverage, which means very low volatility. We've hit our fund objectives. Our credit is doing exactly what it should. So we think our fund stacks up really nicely in that category. And differences in returns for managers that are better or worse, it's also really important to look at what the strategy is. How risky are the things that they're doing? How consistent have they been? And we focused on consistency, a broad segment of the market, stability with our fund.
And if I can add something here. So when last year we decided to launch a private credit option, and obviously we looked at the market and we looked at a variety of different options, both in terms of where fund structure, what type of capital structure to look for, as well as which manager. The reason we decided to partner with Hamilton Lane, and specifically on scope, which is, as we discussed, kind of a first lien secure focus fund, is that we think that the risk reward profile at 8 to 10% being in a higher place in the cap table is actually incredibly good, and especially for our type of client, which want to put a sliver of 10-15%, whatever it might be, of your overall portfolio into a yield generating asset class, a high yield generating asset class, but without taking too much risk, without taking too much volatility. This is part of your kind of a credit portfolio. It's part of your bond allocation. So that's why we decided to go on the lower side of the risk kind of a spectrum on private credit. Why Hamilton Lane is, I asked the very first question I asked Brian at the beginning was, what makes a difference in sourcing? I think that because Hamilton Lane has such a long history in advising large LPs in investing in GPs all over the world, they naturally have developed such strong relationship with all the GPs. They actually allocate money to on a yearly basis. Clearly make them position very differently from some of the big names that Brian was mentioning earlier that are actually single, so they do this autonomously, they compete with everyone else. So this creates a much more diversified type of portfolio. So if you actually, there is a slide where you have there is the slide with the pies, with the diversification, that I think actually makes a big point, because it's actually one of the differences that yeah. If you look at this, so in practice you are co-investing with an incredible number of credit sponsors. While if you were to go for the semi-liquid product of one of the larger or kind of some of the famous names I have in mind, this would be one credit sponsor. So you actually here you have a incredibly higher, you have one coverage. So this is much more diversified than we find anywhere else.
And I'd say importantly, our business as a firm is knowing which managers are good at which things, their skill set, their track record, all of those things. So it's not that we're blindly investing with a whole bunch of managers, it's we're picking the best credit managers in the world to invest in specific transactions with.
Correct. I think that's kind of the story that we think it makes this a unique product in the marketplace. And there are a number of private credit that actually look quite similar from a logical perspective, but this is actually a bit different from an angle because of what Angle Lane is. It's not your typical, just private market manager. It's actually, because of the assets under supervisory, that's where the difference comes in. Now, I want to close maybe qualifying something I said earlier, which also ties into this conversation. When we were the conversation on ETFs versus private credit, I mentioned, if you get an ETF on MSCI Equity World, it gives you, 8-9%, but much more volatile. What I realized I didn't say is that obviously I'm not suggesting you should have 100% of your wealth in private credit, as well as I'm not suggesting you should have 100% of your wealth on MSCI Equity World. The core is, you probably heard me saying this a billion times at this point, is diversify and have a proper portfolio that over time will give you, across cycles the returns you're looking for, and that will come from your the fixed income part of your portfolio. Private credit should be a part of that. It will come from the equity part of your portfolio, where you should have mostly ETFs, etc., etc., etc. So I just wanted to clarify that because you realize it sounded like I was saying, this is same return, 8% to 8%, but less volatility. I was not going to say put 100% of your wealth here. I think this is an incredible opportunity to have a part of your net worth invested in, but I wouldn't suggest any asset for 100% of your money. I think that's it, Brian. Thank you so much. You've been incredibly generous with your time. You answered a lot of questions. Obviously, for all of you guys, we can stay around and have another glass of wine. And I'm looking forward to answering any questions as we walk around.
Thank you for the partnership. Thank you all for spending your time with us. Really appreciate it, and look forward to a beer here as well.